so far, all they've managed to do is essentially keep unemployment flat for the last year in the United States and raise the price of assets. Well, the stock market has finally said, you know what? I no longer believe these policies are going to work. That is the message behind the plunge over the last 2 weeks in the equity markets, and I think we're going to head back down again.
And Mish, in the Economic Consequences book that I published in April, I talk about the fact that just the massive level of global debt will likely be deflationary, and that policymakers around the world at central banks are really printing money, which is essentially debt. So they're trying to solve a debt problem by adding more debt. And the analogy that I like to make is that that's like giving an alcoholic a drink to make them feel better. That works for a little while, but the core problem is still there. And that's essentially where we are internationally. And we're sneaking up on a break here. If you're just joining us, we're talking with Mr. Mish Shedlock. Mish is an economic commentator that's been a guest on Everything Financial Radio. We also talked about the book Economic Consequences. If you'd like to get a copy of it, go to economicconsequencesbook.com. Be glad to send you a complimentary copy. We will be continuing our conversation with Mr. Mish Shedlock after these words. Stay with us. You're listening to the Legacy Radio Network. I'm Dennis Tubbergen, and this is the Everything Financial Radio Show. We're chatting with economic commentator Mr. Mish Shedlock today about inflation, deflation, and Mish, I want to change the conversation topic here for just a moment because something very interesting happened this week since the Swiss franc has appreciated significantly against the U.S. dollar and against the euro. The Swiss are saying, wait a minute, this is bad for our economy. It makes our exports more expensive, and the Swiss central bank recently cut interest rates to near zero. So are we seeing worldwide a slow devaluation, I should say, of all world currencies?
We're seeing what's called competitive currency devaluation. No country wants a strong currency. Germany doesn't want a strong yuan. Japan is complaining bitterly about a strong yen. It's clear that Bernanke is trying to drive the value of the dollar lower, all to increase exports. That's just it. Everyone wants to export. Everyone wants to be to get their economy back humming and to get jobs growth going. Everyone wants to be an exporter. Mathematically, it's not possible. It can't be done. So yet every country is trying to do that, and they all want a weaker currency to do that. The only one right now that arguably doesn't want a weaker currency is the Eurozone, and that's because right now they've got a currency crisis and a tax on their government bonds of Italy, of Spain, of Portugal, of Greece. But prior to that, Trichet complained about the rise in the euro right about these levels. So, he didn't want a strong euro either. Now they're trying to prevent the euro from falling apart, so they'll accept any strength they can get. So, these are the things. And the Swiss National Bank, that's the Swiss Central Bank, went a step further. They're actually discussing a currency peg and currency targets to force the Swiss franc to a certain level. I mean, such proposals are economic madness. Switzerland is tiny compared to the size of Germany alone, let alone compared to the size of the entire 17 Eurozone nation economy. So, and the Forex trading volumes, we are talking many orders of magnitude difference in terms of what it would take to have a currency peg. And let's just discuss that for a second. When a country decides to have a currency peg, they have to defend that at all costs. No matter how many...
Mish, let me jump in there if I could, because some of our listeners may not understand exactly what a currency peg is. Could you give a quick definition, please?
Well, a currency peg is just one country says, and right now most currencies float. The U.S. floats versus Canada. It floats versus the euro. A peg says, a country says, okay, my dollar or my Swiss franc is only worth so much. So we are going to keep it at this rate versus, and they're talking about a peg to the euro. They're going to peg it at a certain rate to the euro. Well, the only way you can peg it at that rate is to be an unlimited either buyer or seller. If market forces want to drive the value of the Swiss franc higher, well, then they have to be willing to sell Swiss francs and buy euros, buy dollars, buy yen, whatever they've pegged to maintain it. And it's the size of the economy difference that says that such a peg cannot possibly mathematically work, and yet they are attempting to propose doing exactly that. They have one thing in their favor right now, and that is sentiment is so overwhelmingly bullish, and I think ridiculously so, actually, on the Swiss franc versus the euro, that it's conceivable that they do one of these actions, and it even looks like what the central bank did worked. But it's not the central bank's action that's working. It's the sentiment is so extreme that you know, if the Swiss franc does go down, it will be because not of what the Swiss bank did, but because sentiment had run so extreme that the Swiss franc was ready to head back down on its own accord.
If you're just joining us, you're listening to Everything Financial Radio. I'm your host, Dennis Tubbergen, and this is the Legacy Radio Network. We're chatting with Mr. Mish Shedlock, and we're talking about currencies. And, Mish, we've got just about 3 minutes left here, and I want to get your comment on something. About a week and a half ago, I heard Bill Gross go on one of the interview shows on television and state that his fund was looking for the cleanest, dirtiest shirt, referring, of course, to the currencies that are least likely to devalue quickly. I don't know if you heard that, but in your mind, can you tell our listeners what are the cleanest, dirtiest shirts, to use that analogy, relating to currency?
I don't know. They're all dirty. I mean, I can make a... I don't... Here's the deal. I don't like the U.S. dollar. I don't like the euro. The Swiss franc is overvalued, so why would you want to buy that? The Australian and Canadian dollars are overvalued, so you don't like that. Now, what I believe Gross is proposing is saying, well, okay, these other currencies are cleaner, but they've also been driven up in price to nosebleed levels. So why buy them here? So arguably, I can look at this and say, currencies, why do I like any of them? As a matter of fact, I don't like any of them. I do like gold. I think gold is a currency, and gold has been on a steady rise, for 10 years now. So 11, actually. It bottomed at around $250 to the U.S. dollar in 2000, and here we are today at close to $1,800. So gold is in fact, telling us what central banks are doing. They're debasing currency competitively, and money's flying to gold. So if you want to say what currency to buy, I would say buy some gold. However, I'd tell you at $1,800, it can correct any time, too. Actually, I want to talk about one more thing, if we can squeeze it in.
We've got about 30 seconds, Mish, so a quick comment.
Interesting news out of Europe today. French President Sarkozy, German Chancellor Angela Merkel proposing balanced budget amendments for 17 Eurozone nations, a financial transaction tax, of which we don't have details, so I can't really comment on, and a true European government. Well, this balanced budget amendment is certainly going to be contractionary for the European economy if they do it, yet it's a good idea. I wish the U.S. would adopt it. I wish we had more time to discuss it.
Mish, we're going to have to end it there. Mish Shedlock, thanks for being with us today. This is the Everything Financial Radio Show. Stay tuned. We'll be back after these words.